key books that really opened my eyes up to how wealth is built was Tony Robbins' book, The Holy Grail of Investing, that came out. I think it came out February of this year, 2025. And it really was eye opening on how the wealthy invest, some of the tenets of their investments that they really focus on. One with professional management, and when you start looking at some of the funds, our institutional funds that raise hundreds of millions of dollars a year, that have had 15, 16 successful exits on funds, and consistently delivering mid-teen returns annually, that you start looking at how individuals build wealth over a 10, 20, 30-year period with being able to have diversified assets in these type of vehicles, where essentially you're doubling your money in 6, 7 years time frame, basically. And so with that velocity of money and being able to generate high income, it allows you to build wealth at a rapid pace. And so that was one of the things that kind of drove me to alternative investments. And one of those really great alternative investments is oil and gas funds. And when you start looking at the cash flow, but one of the largest benefits is for those that are in high income situations, the ability to write off income for your gross income for the actual tax year of the investment. And so that's one of the things that really makes it extremely appealing to go through. But there's due diligence that you have to do. You have to understand the operator, have to understand their operations, how they're set up, what's their investment thesis, what's their track record, how long have they been in business, how successful have they been, what have been the kind of the past returns that they've seen with their funds, and really being able to ask the right questions, because so many times investors, you don't know the right questions to ask. And so that's what everything that we're doing with these coffee chats is, really just exposing the information and having conversation to make sure that we're getting all the information so we can ask those questions to make sure that we're being an astute investor and the best fiduciary of our assets. So with that, let's get going. Let's see. There we go. So important disclaimer before we get started. Quick legal reminder, everything that I'm sharing today is for educational purposes only. I'm not providing individualized tax, legal, or investment advice. Everyone's situation is different. So before taking any action, make sure you talk to your CPA or financial advisor to confirm what fits your personal plan. You want to make sure that it's suitable for you. But simply, my goal today is to educate you guys on the opportunities that exist so you can make informed strategic decisions. So with that, what are oil and gas funds? Give me a second. We got a delay here. There we go. All right. So oil and gas funds are investment vehicles that pool capital from multiple investors to finance drilling projects, the actual production of energy. So you have both the oil and gas side of things. Think of it like a real estate syndication, but instead of buying apartment complexes, you're actually funding the purchase of wells, oil wells. These projects come with two types of expenses. So you have the intangible drilling costs, or what are referred to as IDCs. So things like labor, fuel, preparation of the actual drilling site, the geological surveys that they have, where now they have 3D surveys of like the reserves underground, where they can pinpoint where the actual oil and gas is trapped underneath, where they can actually drill and tap into those things. So those are kind of the geological surveys that drive a lot of the activity that we see above ground with the preparation for the sites. But then on the other side, you have the tangible drilling costs, or TDCs. Those are the physical equipment. So you think like when you hear like an oil rig, the actual, well, that's a picture right there, kind of the oil rig there, the casings, all the machinery, all the actual equipment that goes into extracting the oil and gas from the ground is considered tangible drilling costs. And so the big difference is the intangible costs are typically 100% deductible in the year that they are incurred. So if you're going into and looking at like a oil and gas opportunity, and it's more exploratory in nature, so there's going to be a large upfront cost for new equipment that has to go in to actually tap into the reserves and start drilling the well to start producing oil and gas, compared to maybe one where you see some opportunities where they're buying existing oil and wells. And so there wouldn't be that opportunity to go in and deduct a lot of new equipment because a lot of the equipment is already in place. And so one of the things with the IDCs is where you have that huge advantage in the current tax year. that allows clients to reduce their overall gross income that year. There we go. This internet. There we go. All right. So really look at a quick example in regards to like what a potential looking at $100,000 investment into an oil and gas project. What would that look like? So under and you can kind of go and look at the different IRS code, but IRS, I think it's section 263, it talks about intangible drilling costs. And so one of the big things with this is that the government, the federal government, if you look at the IRS tax code, that is set up in a way where it's incentivizing things to happen. So the government doesn't want to sponsor housing. So guess what? They give real estate investors a tax break. You get depreciation. So it gives you a incentive for private investment to go into these areas to provide housing. And so the same thing with oil and gas. The government doesn't want to sponsor oil and gas and do oil and gas drilling and exploratory drilling to find oil. And so they want to depend on private industry. And so they incentivize investment in those areas by writing the tax code a certain way. So kind of looking at IRS section 263, the intangible drilling costs, let's say around 70%. That right now with the bonus depreciation, you're seeing that get closer 88 to 90% with some of the funds where they are right now. But around 70%, we'll say, can be deducted immediately in the first year. So that remaining 30% or 30,000 represents tangible costs, which are depreciated over the next 7 years of ownership. And so one of the things that you'll see with the 100% bonus depreciation, it allows you to pull that 7-year depreciation schedule. Anything under 7 and 15 years, you're able to pull all those things forward to the very first year of ownership. And so that's how we get closer to that 85, 90% depreciation of the assets in that first year with writing off the gross income. And so for somebody that's in a 37% tax bracket, that you can kind of do the math there, that's going to reduce your income. We're going to use the 70% example, reduce your income by $70,000, which, at that tax rate, that's reducing your tax bill by almost $26,000 in tax savings right away, same year. And so essentially you're getting nearly $26,000 back on day one that you would have had to pay to the IRS, that you're now actually making an investment. You're getting a return on that $26,000 because you didn't have to pay taxes on that gross income. That's money that stays in your pocket, that's not going to Uncle Sam, and effectively reduces your out-of-pocket investment. One of the cool things, why this actually matters, kind of going into my next slide. Man, he's killing me with this. There we go. The lag. But why, for high income professionals, so think doctors, engineers, sales professionals, military officers, business owners, anyone making a high income. A lot of these are allocated only for accredited investors. So when we look at the accredited investor details, that as a single individual, last 2 years making $200,000 of income, with the expectation you'll make the same thing going into the next year, or 300K as a couple, or having $1 million net worth. And so for like my military individuals that have a retirement or pension, is to really work with your CPA to understand your expected life expectancy, and to produce a letter that identifies the value of that pension. So if you're making $6,000 a month in retirement, now you're expected to live till you're 75. Then now they can give you a letter and give you a value on that pension that you have. And then a lot of times we start looking at retired officers that you may meet that $1 million net worth a lot sooner than you think, just being able to have that pension and what that pension actually, the value of it. So that's one interesting thing to kind of really look at and talk with your CPA. But why this matters to high income professionals, that you're paying a huge portion of your income is going to Uncle Sam in taxes. And so let's say you're earning $150K a year. By strategically investing something like an oil and gas fund, you can reduce your taxable income by that $70,000 deduction that we kind of talked about with that rule. But it saves you $25,900 in real tax dollars. So now you're looking at how you shift the income. You're turning the liability taxes that you were going to pay anyway into investment. that has the potential to generate both income and appreciation. And that's the thing that I think for a lot of people that is flipping the script when in regards to now you're able to turn your tax burden into a wealth building strategy. And at the same time, when you're going through and looking at what's being produced, that you're getting cash on cash return on your investment. Most funds look to pay out over a 5 to 7. They have a 5 to 7 year time horizon for the investment. With most funds looking at all 100% of the capital coming out is to repay investors, the partners in the deal, before the operators start taking profit on the oil wells. Because some of these oil wells, depending on the strategy, because some give you opportunity to sell early on. They may have their business may look to sell, but there's some cash flowing funds out there that some of these wells can produce 20, 30, 40 years into the future, depending on the production rate and the price of oil, that, it could be a long-term cash flow play. But the big thing is getting past that 3 year mark where you don't have any recapture with the tax benefits. And then that way, if you're looking to do an exit, you can pull your capital out if it's allowed with the fund. And so that's some of the things to look through with the different funds and their investment thesis to kind of see what makes sense for you. Do you want to have your money tied up long term? Or you really good with cash flow? Maybe looking at doing a IRA conversion or deduction where you're taking capital out of a retirement account and you're looking to offset that tax bill with doing a withdrawal from your IRA. And now it makes sense to maybe fund, to move funds into an oil well where you don't actually have to, if you're not dependent on that capital in the same year, or you're forced, you're at the age of 72 where you're forced to take that minimum deduction or distribution, then now you can look at deferring that capital or investing that capital into a fund where you have tax benefits that come with it that offset the tax bill that would have came with that distribution that you would take. And so a lot of different opportunities to kind of look at and talk and visit with your CPA or your advisor on how to go about making the right investment for you and making sure that you're always taking taxes into regard on everything that you're doing and how you're moving money and how you're making investments, because that is extremely critical to being able to keep the majority of your money, if not all of your money, into your own pocket. And so kind of looking at best practices that you need to just continue to make sure stay informed, surround yourself with the right experts, conversations that we're having today, talk to your CPA. Hopefully they understand oil and gas. And if not, you need to make sure that you're talking with them or they're getting the information and understanding the impact that that's having, as well as advisors. There's organizations out there like the American Association of Petroleum Geologists, different webinars that oil and gas companies have out there, and just really learn how these investments are structured. And but I think the big piece to really go back to is the CPA, financial advisor, being able to make sure that they understand the nuances for the oil and gas and how it fits into your overall financial plan and everything that you're building towards retirement. They're making sure that you're making strategic investments that align with your tax strategy and your financial plan. And if it's something that you don't have a financial plan or you don't have an overall strategy, then that's something that we can have a discussion about as well too, and kind of walk through that. But one of the things is definitely keep your eye on the market where, there is risk inherent with any investment. Oil prices, production costs, regulation, they all affect returns, and so you want to know where's that break even point. Is 60, if the price of oil drops below $60 a barrel, is that the break even point for them? And just understanding some of those questions to ask and understanding the different funds and their investment thesis is going to go a long way to make sure that you're an informed investor and making the right decision for you and your portfolio. But looking at, just beyond the tax benefits, that a lot of times people overlook just, other things that's going, you have the depletion allowance, because we know the oil and gas that you're depleting the resource that's underground. So there's a, 15, up to 15% of the production income can be excluded from taxes to account. So that cash flow that's coming in each year from production, 15% of that gross income is excluded from taxes. And so depending on how the investment is structured, your losses may be treated as active, meaning they can offset ordinary income. You still have some depreciation. So those tangible assets like the drilling equipment, they're depreciated. but with the great thing now with the 100% bonus depreciation law that just got passed, that now all that depreciation you're able to take in the very first year. So it really, for a lot of people, it makes sense to stay in for that 3-year minimum and look at now once they've exhausted the majority of like the tax benefits. Now you don't have that recapture once you own the investment more than 3 years. Now you can take that capital, sell the oil, they can sell the wells. And so now we're just seeing a lot of funds looking at how they're refining their strategy. So you have a lot of flexibility. And so having your plan and understanding what your strategy is going to drive a lot of the opportunities and what you want to look at taking advantage of with that. So going a little bit more into diversification and just the leverage. At the end of the day, it's all about diversifying. Like we're at all-time highs when we look at the market. With AI, we could be in a bubble there with just the trillions of dollars that's being poured into AI technology. So really look at, your portfolio with your advisor, understand your balance right now. Maybe it's some time to kind of go back and rebalance, with the appreciation that we've seen in stocks. Thanks the market overall is almost up 100% from like from 22 time frame when we started rebounding from the big loss was that August of 22 time frame. So rebounding from there, that really looking at your balance across your entire portfolio is a great time to rebalance right now, and making sure maybe it's a good time to maybe look at taking some chips off the table and maybe allocating towards some alternative investments where you can have some true diversification, just depending on where the market goes in the future. And so oil and gas investments, they tend to move differently than stocks or real estate. But, the thing is like having that diversification now allows you don't have all your eggs in one basket at the end of the day, which opens up for more exposure. Because the last thing that you want to do is have to worry about making up returns that you've lost when the market shifts and goes back the other way, especially if you're dependent on that income actively for retirement. So with that, I think the big idea is to understand that there is a extremely diverse portfolio. When you start talking about the wealthy and what they have access to and the investments that they leverage to grow their wealth, that it's more than just the traditional stocks and bonds out there. And so today just kind of really wanted to kind of tap into oil and gas and just kind of expose you guys to a little bit of that, but really looking at what makes sense for you guys, for you all in this investment arena is really to kind of take a look and talk to a professional about what that means for you and your specific situation, because there's a lot out here that you can definitely benefit from. And we'd love to have a conversation, kind of talk through individual scenarios and kind of just book that call. I got a lot more time now that I'm officially retired, and just going through with some of these things that we're sharing. And like I really don't share, really just kind of stick with these with kind of forward facing where everyone is just really for education purposes, but a lot of the individual funds and everything that we can kind of share that one-on-one to kind of go in to specifics of what we've seen, what our broker dealer, what we have approved, the different funds that we have access that we can help investors invest in and go through. I think, who was that? Someone said U.S. Energy. U.S. Energy is one of those that has been approved. I know a couple of our advisors have already, they've been allocating with them for a few years now. And and so there's some trade-offs, Tiffany. So we can definitely talk about that with just kind of their approach. Because the big thing is really just you want to understand the risk of the operations, how they're approaching it, their track record with returns and their business model, just to make sure that you're not taking on more risk. Some are more cash flow, income based, and less exploratory, higher risk, which potentially has a higher return, because if they hit really good reserves, then it could produce a lot of income, which would be a lot of cash flow, more long term. So it just kind of depends on your risk profile. Or do you want to buy something that's already a fund that's already established, that's looking to buy existing wells, not a lot of risk, it's already producing, they already have a good understanding of the geological survey for the actual area and for the wells themselves, so they can kind of predict out, hey, this is what we estimate the return to be. And there's a track record to kind of already look at, versus just taking a survey with no equipment in the field and you're just going out drilling that, you could be successful, you could not. And, but higher risk, you want to make sure hopefully there's a higher return. and there are risk pieces to it. So make sure you take some of those things into account and do your due diligence on the operations. Like that's with any investment, you want to do your due diligence on the operators, the team, their track record, you know, their consistency in giving returns in the past. Have they been around for 3 years or have they been around for 50 years? And, and just understanding the perspectives and their business model and making sure it aligns with your long-term goals. And that's why you got to have a plan. You need to have your plan documented on what you're trying to achieve, because if you don't have a plan, you're planning to fail, that you're just kind of going out here aimlessly. And there's no need for that today, especially for those in this community. So with that, I'll open it up for any questions, a little bit of discussion. That was all I really had prepared to talk about today. Anyone currently investing in oil and gas that's on the call?
Hey, Johnny. I am not investing in oil and gas, although I do know a real estate group that they started like their own DPP fund. They essentially fund an apartment building or similar project about once a month, and one of their projects recently is a DPP. Yeah.
For okay.
Oil and gas.
Yeah, so DPP, direct participation programs. So essentially all the funds, private equity, private credit, oil and gas, commercial multifamily funds are considered direct participation programs.
Yeah, I hadn't heard about it until probably 6 months ago, and now I've heard about it a couple times.
So Johnny, I'm a fund manager. I've brought capital into various deals, multifamily. We're doing medical office now, but I'm constantly on the lookout for other great opportunities to bring investors. And over the last 2-3 months, me and some of my peers have been digging in on some oil and gas. There's several opportunities out there. Okay. They all have a little bit different flavor. You get in at different times. But what we've concluded is, one, the tax benefits are great the first year, because unlike multifamily or I guess real estate, you get the great tax benefit that goes against your active income. However, all your future distributions are going to be taxed as active income. So you really got to trade it off there. The other thing on this particular deal we were looking at is the cost per the break-even price on cost per barrel. Basically, how much does it cost to get a barrel of oil out of the ground,
right,
versus the spread or the margin of what the price per barrel is right now. And it was $40, and right now the cost per barrel is, I think it's 63. So the margin isn't huge. OPEC is likely to open up more supply and cause that gas prices to drop further, which is cool for every one of us who go to the pump, which is less cool for investors. So it's kind of it's a catch-22 really for investors. But between the distributions being taxed as active income and the questions about price per barrel, it really doesn't make sense for us to open up a fund, especially in the oil and gas world, where you could invest in some pumps that don't pump as well as you'd hoped.
Yeah, no, I think, understanding the business model and where the market is. And I think that's the big thing when you start looking at diversification in the portfolio, where the reasons why you don't put all your eggs in one basket. I know one of the strategies that we've seen with some of the clients, as they're producing that income that's taxable, that rolling that capital, because a lot of investors, they're still looking for appreciation, not necessarily focused on the income, that they take that revenue that's generated from the oil wells and they reinvest that capital. And so they start that process of reinvesting those returns and start building the compounding effect with that. So it's different strategies, and you need to understand. That's why it's important talking with your CPA on just where it fits into your overall tax strategy for your portfolio and what you're looking to gain. just because you're going to have some nuances on how it's going to impact your bottom line and your income that you're generating. But, for a retired individual that doesn't have a lot of active income, they may be okay with paying those taxes that's coming off the distribution off that investment that they made. So it definitely is something to definitely kind of think about with the tax exposure there and just how it fits into your overall strategy. But yeah, that's something to look at with oil production and as well as where the market is going, where projections are going with inflation, with the economy right now. Where the job losses and just the impact that we're going to have there. I think there's a lot of different variables at play that we have to manage and kind of sort through. And I think a lot of times now what we're looking at that if you don't have a plan and you're just trying to navigate by the seat of your pants and just kind of take it all in as a lone ranger or a lone wolf, that it can be daunting if you got all that on your shoulders trying to manage your own portfolio. And I think one of the benefits of really having professionals, CPA advisors, and people around you, and just having a network is you're hearing what other people are doing, the strategies they're using, how they're managing their portfolio, how they're managing risk, and just understanding the opportunities that are out here and the tools you have that you can use. No, I think that's really good. And so with the fund model, is it a certain area you guys are kind of leaning now for investors?
Yeah, I mean, I'm not going to pursue raising capital for it. One, I think the risk is too high at this point in time. Plus, going in, I was a little ignorant as to the tax benefits because you see on the surface, everyone says, "Oh, you get great depreciation off of your active income, or you get great write-offs off of your active income," and that's like the number one driver that gets people in the door. But what's not looked at is how the distributions are taxed. So you just got to think about it. I mean, if you're going to put $100,000 and you're going to get a good chunk of that, say $80,000 in the first year, that's a tax write-off. That's pretty cool. Or maybe it's $50,000. But then as you're getting your return on investment, that first $100,000 is all taxed as active income, just earning what you put in just to get back. And then maybe you 2x and get $200,000 in 7 years. You just got to think about the full life cycle of it. Same goes with multifamily. I mean, we always talk about great depreciation. It doesn't go against active income, but at the sale, there's a recapture tax that everyone needs to think about. So this is, just think the full life cycle of a property and how it will impact you. And everybody's different. I mean, the wealthy invest in all of this stuff because it makes sense to all of them. And they're playing those tax strategies very specifically. So I'm not saying don't do it. I'm just saying for my fund and my investors, that's something I didn't want to pursue at the moment. If the cost per barrel is, 92, I think it kind of be a no-brainer because you're just going to make a whole lot of money out of the gate. What concerns me is a lot of the pumps, they produce the most amount of oil in the first, say, 3 years, and then it depreciates after that, and then it runs drier, say, and then it's not worth it in year 7. And then it just costs more to run the pump than it's producing. So if your cost per barrel is low right now, and say the cost per barrel goes up in year 6, you're not going to be producing that much. So, whole picture.
Yeah, no, 100%. And I think the real investment side of it is, that first year tax, if you're saving $27,000 that you don't pay taxes and you invest that capital, and if you make 10% on your $100,000 that second year, you're going to pay taxes on $10,000. And if you're at a 30% tax bracket, you're going to pay essentially $3,000 in taxes. So over 4 or 5 years, that's 3,000, 4 years, that's 12 grand in taxes. So you're still winning, from that big tax write-off that you had the very first year. And if you start reinvesting that capital and deferring those tax checks that you got to write to the government, then I think, like you said, for the right person, it still makes sense because you're still coming up on top from a tax perspective.
Yeah. And to think about it, just other examples out there. We were looking at some debt funds, really high paying debt funds, like 15, 20% returns. Uh, on a debt fund, you don't get any tax benefits, and your distributions are considered active income. So for high income earners, you could potentially in high tax states like California, you could be paying almost 50% taxes on your investment. So for those who this makes the most sense for, if you're a high income earner and you have a solo 401k, or if you have self-directed IRA, throwing that money at the debt fund, because it's cash flowing, the cash flow is great. You don't get taxed if you're using those retirement accounts to invest in those vehicles, versus if you're a high income earner and you just invest cash, that may not be the best play, because by the time you're taxed 50%, you're making 15 in your pocket, and then being taxed, you're going to make what, 7 to 8% net. You might as well have your money liquid and just put it in an S&P index at that point.
Yeah, no, that's a great point. Those solo 401ks, so essentially a retirement account for like a LLC or individual business owner, like some of those vehicles, and using your IRA to invest in some of these opportunities is a great way to defer taxes, or with the Roth to, completely, grow your money tax free in some of these high cash flow, because there's opportunities out here where, you're getting, low teen, mid teen returns routinely. And that's not anything that is, crazy, for some of these type of investments that are paying, so private credit. So essentially a private bank. So think hard money lenders, or, say Tesla wants to borrow money. They don't want to go to Wells Fargo. They may go to a private credit fund that'll lend them money at 12%, and they're paying their investors 9% or 10%. And they're just kind of managing for 2 or 3%, whatever that spread is there. And so there's a lot of, opportunities out there that you can invest in. So income, your active income, but also, some of your qualified and unqualified retirement accounts are opportunity. That's a good point, that, some of these vehicles may make sense for a different vehicle to use to invest in. So, no, thanks for sharing that. Any other comments, questions, or
I'm just gonna chime in
anything else?
Yeah, just gonna chime in real quick, Johnny. So this, while FJ is talking about the debt funds, it kind of reminds me of how John D. Rockefeller, is one of the first self-made billionaires in the US. Now it makes more sense, from oil and gas funds to the finance world and then the real estate market. I think that's how he kind of did his, really smart strategy. Like rolling over the funds coming from the oil and gas to the debt, making it, in the bank world, and then to real estate. Now it all makes sense. It's really just how you're gonna, put it all together as a strategy, and how you're gonna like align all of this to your goal financially.
Well, yeah, I think you bring up a great point, because all of it goes into income and a lot of times you see a lot of successful people, if you want to put a dollar figure on it, millionaires or whatever, that generate high income, they became world class or really great at whatever their niche is or their focus area. And then once they make a lot of income, they make a lot of money, they look up and like, oh, what else is it that I can invest in? Or what other businesses, now that I'm great at this, what other businesses can I start and take the experiences that I have at this point and provide an impact in those areas, and now diversify and preserve my wealth and continue to grow it. So I think that's the number one thing with all of it, is how to generate more income, where you have some of these new problems to have to deal with how to invest your money, how to stop paying so much in taxes, how you can defer taxes, how you can grow wealth tax free. And so having a lot of those discussions, but it really comes that if you don't generate a lot of income, then now you have another problem, is that you need to focus on generating more income. Is it starting a side hustle? Is it starting a business? And a lot of times, for like even my story, that real estate became a side hustle that grew into a business with just getting really good at finding off market deals where I could force appreciation, where they were dilapidated houses that look bad, that we can go in, flip them, keep some as rentals, generate income when we sell the flips. And then it grew into, doing the same thing, but for smaller apartment complexes and looking to own those long term for the tax benefits and then for the passive income cash flow with that. So, everybody has to figure out their strategy and, building, whether it's, becoming a consultant, leveraging the skills that you have on your W-2 job, or maybe it's looking to, maybe go to another job where you can take a promotion and doing that. And so I think right now, especially for a lot of government individuals, that you're going to have to recreate yourself, look at different opportunities on how you can create your own economy. Because right now, I know, for instance, in the DC market, DMV area, DC, Maryland, Virginia, that a lot of government individuals met for different agencies have been laid off, or, they took a leave of absence or retired. And now the job market right now is just saturated with talent. A lot of companies are hiring. And so there's a lot of, quality candidates that are looking and seeking employment. And so for a lot of people, they may have to look at, creating their own job opportunities and providing services and leveraging their skill set in different ways. So I think it's just definitely something to kind of think through at the end of the day on how we're generating our income, having those multiple streams of income, and then how are we investing the income that we're able to produce and becoming an astute investor.
And it gives a different meaning to diversification, because now I think all these different strategies that we're talking about, besides, on top of beyond real estate, is more of like not just like the different strategies to put, or the different investments, is whether we're going to use it for income generation or income preservation. So it gives a different meaning to how we are going to diversify.
Yeah, and the time that they have that conversation is when the market's at all-time highs, and not when it's starting to go back the other direction, because then it may be a little bit too late at that point. So this is the time to have those conversations and kind of a deep dive analysis on where things stand today when times are good and everybody's exuberant and their life's good from an investment standpoint. Like, hey, this is the time to kind of maybe take some chips off the table, diversify, get everything in order. Or hey, well, when Murphy happens, when something goes the opposite direction that you didn't plan for, that you can sleep at night and that you got everything in place, you got a solid plan. So great conversation, FJ. Thanks for great feedback and insight on those things. I see this right here. Is it
the creature from Jack?
Yeah, that's a good one. I never finished the book. I think I listened to a YouTube video of the author talking about it, but yeah, and how they created the U.S. tax code.
I audiobooked a half of it, and I haven't finished it yet. It's a heavy read though. Just going into it. Yeah. But it's also eye-opening, and it's kind of concerning as well, because we're just in a spiral, in a spiral downhill, and it's never going to end. This is why I think the whole crypto and blockchain has legs, because the fiat industry and the way it was built, based on how it's explained in the book, it's just eventually going to crash, and this is where other currencies can shine. When? I don't know.
Yeah, because you think about it, the Fed's target is 2% inflation a year. So that's like every decade you're losing, best case, 20% buying power. So it's like, okay, 20 years from now, you lost 40%. Best case, and a couple of years ago, inflation was at like 9% in 2022. So it's like we're seeing the income gap right now, and it's only getting worse. And asset prices aren't going down. So if you don't own assets, you don't own real estate, you don't own stocks, you're not in some of these asset vehicles, then you're going the wrong direction, and you're getting further and further left behind. And it's extremely hard to make up that gap the larger and larger it gets. And so I agree. I don't know how we we get out of this death spiral. But inflation is going back up now, and yeah, you look at the Mag 7, the top 7 stocks, and all the rest of the companies below the top 7, and where returns are. It's like there's no fundamentals anymore. I'm looking at like nuclear, uh, these new hydrogen and nuclear, stocks, and it's just everything's being run up with a lot of the new technology that's coming online and that the government's pushing. It's like, how are these things going to 200%? They haven't produced anything, any minimum value products or anything that's come to market yet, but just on headlines, people, they're just running up and pumping up. So I don't know. It's an interesting time. And so you definitely want to be informed.
Yeah.
And
Energy, other than oil and gas, I haven't gone down that rabbit hole, but the whole AI and the amount of data centers being built and the data centers demand on the electrical grid, you're right, there could be something there with I mean, nuclear power. France has been doing awesome with it for a long time. I'm a fan of it because
yeah,
it can
yeah,
produce a lot of electricity. So I'm sure there's some investments in that world that might be worth it, given that AI is driving so much demand.
for sure, for sure. Well, awesome. With that, definitely reach out. Let's have some conversations. If I can be a resource in the future, or anything. I know we have a couple other sessions. I know we're going to have looking to get Heritage IRA to come talk about some of their different IRA solutions that they have to provide you guys, and just opportunities on the strategies on how people are leveraging 401ks and using retirement vehicles to build wealth. And so, as
Are they
well
a
as looking at,
custodian?
they are. Yeah. Yep. So they'll come from a custodian perspective, just talk about the products and just some of the ways that you can leverage that. And there's some really good scenarios. They had I met, it wasn't a founder, but it was one of their account reps. But he was sharing one of the stories of this individual that had a self-directed Roth IRA, and he moved over. This was 2011, 2012 timeframe, and he started out with $70,000 that he moved into his IRA. And so he started buying subject to real estate in Austin, Texas over the next 2-3 years. And he's built up, starting with $70,000, subject to taking over existing mortgages on real estate during that time frame in Austin, Texas, that he's built up over a $4 million portfolio inside his IRA, starting with 70K. And just taking on these properties with existing mortgages. I think a few of them are already paid off, and the rest of them are getting close to being paid off. And so now he's looking at, selling a few of those properties, making other investments. But, you just got to start taking action that, once you make those investments and let time does what it do for investments, and start compounding, building wealth, leveraging, in this case, buying cheap properties that who would have known the run up in appreciation that we would have in Austin, Texas. And, increasing the value, having debt in other individuals' names, and that's paying down that debt over time, and the cash flow coming in from the rentals, that, just a $70,000 investment using creative financing and using different strategies like that in the right vehicle can help you build wealth long term. And so that's just, buying a handful of properties one time and just sitting back and managing it and being a good steward over the investment. So, but the thing is, the best time to buy real estate probably was 20 years ago. The next best time is today. And I'll say that goes for any investment that you're making, that you're informed and that you have knowledge about, that's going to serve your purpose long term. That looking at how we can get away from just being consumers, and now looking at being more producers and buying assets that produce value is the name of the game. So with that, see you guys next Wednesday, if not sooner. Definitely let's hop on a one-on-one if I can add some value or anything from there. And I don't think we have anything major coming up in regards to events. Well, we have, I know the ADPI real estate investing conference is happening in San Antonio this weekend. And what else am I missing, Faye?
Yep, so we're going to be launching the REI News in terms of like the branding. We're going to be picking members that we can help with pushing their brand and services.
Yes.
So if you guys are, one of those who needs help generating leads, leveraging AI and how all these systems are being set up on how you can create your 2.0, basically, feel free to reach out. We'll be posting that on the school community, and exclusive for the REI Genius members. But if you have, any questions, we drop the link right there so we can, meet you guys for the alignment call, and let's see how we can help. We'll bring on, we'll do an assessment first and see if it's something that we can, help you with. But basically, it's just creating the systems, creating your personal branding, especially with what's going on right now. You know how crazy it is. You are your business, so you're carrying the business with you. I remember this one movie, like I'm not a businessman, I'm a business man. but you get what I'm saying, right? It's more of like we are our own commodity. So right now, if you're not online or if you're not present online, you're not in the business. So yeah, we're looking forward to, to see who we can help in terms of like um boosting your credibility online and offline.
Yep. Yeah, thanks for that. I completely forgot about that. And that was something that conversations that I've had with multiple people just about, how to show up in the marketplace and how to add value. And so that was some of the things with like the branding and content creation, things like that, that really kind of opening up the curtain and sharing that with those that are interested. It was I had a conversation on the way to the airport yesterday with a young man from the University of Alabama that I think he's with New York Life and just starting out in the financial advisory space. And that was the no question. He's like, how do I get known? How do I find clients? And I feel really bad for him because like the company isn't really helping him generate leads or training them on how to generate leads for his business. And it's like they almost setting them up for failure just because they're not, training them how to build a book of business and do things and, how to add value and how to really provide value to people is number one with any type of service. And so, with being able to help, whether you're in a service job or, whatever, industry, that if you feel like, your personal branding needs attention, then yeah, we're definitely going to be here as a resource to help with that and kind of leverage some of the strategies and things that I've learned over the last few years. So, good stuff.
I'm excited.
All right. Well, we're 1 minute over. Everybody have a great rest of the week. And reach out. Let us know how we can help. Good seeing everyone.
See you all next week. Have a great one.
Have a good day.
Bye.